Tax cuts and spending slowdown are two alternative ways of achieving fiscal consolidation, which is the reduction of the government budget deficit and debt. Fiscal consolidation is often seen as a desirable goal for countries that face high levels of public debt or fiscal imbalances. But what are the pros and cons of these two methods? Tax cuts are reductions in the amount of taxes that individuals or businesses have to pay to the government. They can take various forms, such as lowering income tax rates, increasing deductions or exemptions, or providing tax credits or rebates. Tax cuts are often advocated as a way to stimulate economic growth by increasing disposable income, consumer spending, and investment. They can also improve incentives for work, saving, and entrepreneurship by reducing the tax burden on these activities. However, tax cuts also have some drawbacks. First, they reduce government revenues and create either a budget deficit or increased sovereign debt. This can lead to higher interest rates, crowding out of private investment, and lower economic growth in the long run. Second, they can increase income inequality by benefiting the wealthy more than the poor. This can reduce social welfare and create political instability. Third, they can reduce the provision of public goods and services that are funded by taxes, such as education, health care, infrastructure, and national defense. This can lower the quality of life and productivity of the population. Spending slowdown is a reduction in the rate of growth of government spending or an outright cut in spending levels. It can affect various categories of spending, such as discretionary spending, which is determined annually by Congress, mandatory spending, which is determined by existing laws and programs, or interest payments on the debt. Spending slowdown is often advocated as a way to reduce the budget deficit and debt without harming economic growth by cutting wasteful or inefficient spending. It can also improve fiscal discipline and credibility by signaling the government's commitment to sound public finances. However, spending slowdown also has some drawbacks. First, it can reduce aggregate demand and economic activity in the short term by lowering government consumption and investment. This can lead to lower output, income, and employment, especially during recessions or periods of weak growth. Second, it can harm vulnerable groups that depend on government transfers or services, such as the poor, the elderly, the disabled, or the unemployed. This can increase poverty and social exclusion. Third, it can undermine long-term growth and competitiveness by cutting spending on public investment or human capital development. This can lower the potential output and productivity of the economy. In conclusion, tax cuts and spending slowdown have both advantages and disadvantages as ways of achieving fiscal consolidation. The optimal mix of these two methods depends on various factors, such as the initial fiscal situation, the state of the economy, the distributional effects, and the political feasibility. A balanced approach that combines both revenue and expenditure measures may be preferable to an extreme reliance on either one.